Imagine waking up one day only to find your savings vanished, businesses shutting down, and millions of people out of work. This was the reality of the Great Depression, a decade-long nightmare that started in 1929 and gripped the world. The stock market crash in October 1929 was the spark that ignited a global economic firestorm. Wall Street's sudden collapse sent shockwaves through the global economy. People had invested everything they had, hoping for riches, but instead, they lost it all in an instant. Factories closed, banks failed, and families struggled to survive. Unemployment rates soared, with 1 in 4 Americans unable to find a job. But this wasn't just an American problem. The Depression spread like wildfire across the globe, impacting countries across Europe, Asia, and beyond. Every corner of the world felt its sting. Families lived in poverty, and governments scrambled to find a way out. In Germany, the economic turmoil contributed to the rise of extremism. While in the United States, President Franklin D. Roosevelt's New Deal aimed to provide relief and reform. So, how did the world recover from such a massive disaster? The lessons of the Great Depression led to significant changes in economic policy and financial regulation. The establishment of social safety nets and the regulation of financial markets were direct responses to the crisis. The Great Depression remains a powerful reminder of the fragility of economies and the importance of sound financial practices. Banks, once considered unshakable, are suddenly on the brink of collapse. Homes foreclosed, jobs lost, and economies thrown into chaos. This was the 2008 financial crisis, a disaster that rocked the world and left many asking, how did this happen? It all began with a risky game played by banks. They gave out loans to people who couldn't afford them, betting that home prices would keep rising forever. But when the housing market crashed, the bubble burst. Mortgage companies failed, and big banks like Lehman Brothers went bankrupt. Panic spread like wildfire. The stock market plummeted, wiping out trillions of dollars in wealth. People lost their homes, their jobs, and their trust in financial institutions. The crisis wasn't confined to the United States. It spread globally, sending shockwaves through Europe, Asia, and beyond. In the UK, banks like Northern Rock needed government help to stay afloat. In Iceland, the entire banking system collapsed. Countries faced recessions, and millions of families saw their dreams shattered. Governments scrambled to bail out failing banks and stimulate economies. So, what lessons did we learn from this financial earthquake? One major lesson was the need for stronger financial regulation. The aftershocks of the crisis are still felt today, reminding us of the importance of vigilance in financial practices. In 1997, a sudden economic storm left millions of people across Asia struggling to survive. Countries that once seemed invincible to financial trouble found themselves on the brink of disaster. What happened, and how did some of the world's fastest growing economies fall apart so quickly? It all began in Thailand, where the government's decision to devalue the baht sent shockwaves through the global markets. Investors pulled out, and panic spread like wildfire. Soon, the currencies of countries like Indonesia, South Korea, and Malaysia were crashing too. Stock markets tumbled, and businesses closed their doors. In Indonesia, the crisis led to violent protests, while South Korea had to turn to the International Monetary Fund for help. So, what caused the crisis? Rapid economic growth in these countries has been fueled by massive foreign loans and investments. But the bubble burst when the Thai baht collapsed, triggering a chain reaction. With heavy debts and no way to pay them back, many economies crumbled under pressure. To stabilize things, the IMF stepped in with bailout packages, but these came with tough conditions that led to even more hardship for the people. The 1997 crisis left deep scars across Asia. But it also taught vital lessons about financial stability and regulation. Today the region is better prepared, but the memory of the crisis still lingers as a reminder of how quickly things can change. What happens when an entire country's economy grinds to a halt? When savings vanish, jobs disappear, and the government is powerless to stop the chaos. In Argentina, from 1998 to 2002, this nightmare became a terrifying reality. Imagine waking up one morning to find your bank account frozen, your savings gone, and the national currency rapidly losing value. Millions of Argentinians endured this harsh reality during one of the most severe economic crises in history. The country's economy, once seen as a model of growth in Latin America, spiraled into disaster. How did it happen? Argentina's government had tied the peso to the US dollar, hoping it would stabilize the economy. But the system failed as Argentina sank deeper into debt. By 2001, the country's foreign debt had grown to an impossible level, and the government defaulted. The economy collapsed, unemployment soared, and inflation skyrocketed, leaving people unable to afford even basic goods. In desperate protests, millions took to the streets calling for change. Banks shut their doors, freezing savings, while families scrambled to survive. The economy shrank by 28% in just 2 years, an unimaginable blow. International help came, but the recovery was slow, leaving deep scars on the nation. So, how did Argentina rise from the ashes? Through a combination of international aid, economic reforms, and a gradual rebuilding of trust in financial institutions, Argentina slowly recovered. The lessons learned from this disaster continue to shape the country's economic policies today. The Argentine crisis stands as a chilling reminder of how quickly prosperity can turn into ruin. What happens when a nation suddenly can't pay its bills? When the rubble crashes, banks fail, and the government collapses under the weight of its own debt. This was the terrifying reality for Russia in 1998, a year that shook the very foundations of the country. In August 1998, Russia's economy faced a nightmare. The ruble, the country's currency, plummeted in value, losing half its worth almost overnight. Investors panicked, pulling out billions of dollars from the country and causing the stock market to crash. The government defaulted on its debts, unable to pay back loans to foreign countries or keep up with domestic spending. The situation spiraled out of control. How did it all begin? Throughout the 1990s, Russia was struggling to transition from a Soviet economy to a market-driven one, facing inflation, corruption, and economic instability. In the background, oil prices were failing, and the country's foreign debt was growing larger. With little warning, Russia's central bank ran out of money to support the ruble, and the government declared a default. What followed was chaos. The economy shrank, inflation soared, and millions of Russians lost their savings as banks froze accounts. Protests filled the streets, and many feared the country might collapse into a full-blown social crisis. How did Russia bounce back from this? It took years, but the Russian financial crisis forced the country to rethink its economy. Through economic reforms and stabilization efforts, Russia gradually recovered. The scars of 1998 still influence Russia's policies today, showing just how fragile even the largest economies can be. When a nation's debt spirals out of control, it can threaten to tear apart the very fabric of society. For Greece, between 2009 and 2018, this was a terrifying nightmare that seemed impossible to escape. It all began in 2009 when Greece revealed that its budget deficit was much higher than expected, much higher than the European Union's rules allowed. The country was drowning in debt, with billions owed to creditors across the world. The world watched in disbelief as Greece's economy, once a proud symbol of ancient power and modern tourism, seemed to fall apart overnight. But the crisis wasn't just about numbers, it was about people's lives. As Greece's economy collapsed, unemployment soared to over 25%, and many young Greeks faced bleak futures. The government implemented harsh austerity measures, cuts to public services, pensions, and wages, hoping to convince international lenders, like the European Central Bank and the International Monetary Fund, to bail them out. But these measures sparked outrage. Protests and strikes became a daily occurrence as the Greek people demanded relief. Still, the debts kept piling up. The fear of Greece leaving the Eurozone loomed large, a potential disaster that could trigger a global financial crisis. The crisis finally began to ease after multiple bailout packages, but the scars were deep. What does it take for a nation to survive such a financial catastrophe? And can Greece ever fully recover from the devastation that almost destroyed it? The Greek debt crisis stands as a haunting reminder of the consequences of unchecked borrowing and unbearable weight of national debt. In 2008, Iceland, a small island nation known for its stunning landscapes and strong economy, found itself on the edge of total financial collapse. The country's banking system imploded, its currency crashed, and the government had no choice but to seek help from the outside world. The answer lies in the Icelandic financial crisis. Iceland's once booming economy was built on an aggressive banking strategy. The country's banks had borrowed massively from foreign markets, growing exponentially in size. But when the global financial crisis hit, the bubble burst. Iceland's banks were unable to repay their debts, causing them to collapse under the weight of their own failure. The government was forced to step in, nationalizing the major banks and offering a bailout, but the damage was done. Within weeks, the Icelandic krona lost 50% of its value, inflation soared, and unemployment rose sharply. Iceland's government couldn't manage the overwhelming debt, and the country faced an international crisis. Ordinary citizens were devastated as their savings vanished, and protests broke out, demanding justice and accountability. In response, Iceland took drastic measures, allowing the banks to fail, a rare decision in modern financial crisis. This bold move, combined with a series of reforms, ultimately helped the nation recover, but the scars of the crisis remain, serving as a stark reminder of how fragile even small economies can be in the face of global financial storms. Venezuela, once one of the wealthiest nations in Latin America, now finds itself in the grips of an unrelenting economic collapse that has left millions struggling to survive. How does a country rich in natural resources, particularly oil, descend into one of the most severe economic crises of the 21st century? The Venezuelan economic crisis began in the early 2010s, when falling oil prices and years of economic mismanagement exposed the vulnerabilities of the nation's economy. Oil exports accounted for around 95% of Venezuela's income, and when global oil prices plummeted, the government had no backup plan. The country's already weak economy went into freefall. Inflation skyrocketed, reaching an unimaginable 1,000,000% in 2018. Basic goods like food, medicine, and even toilet paper became scarce. People stood in long lines for hours just to buy necessities, and hyperinflation rendered the national currency, the bolivar, practically useless. Unemployment soared, and wages became meaningless as prices skyrocketed. As the economy collapsed, political instability followed. A power struggle between the government and the opposition led to mass protests, further deepening the crisis. The government, led by Nicolas Maduro, faced increasing international isolation and sanctions, while millions of Venezuelans fled the country in search for a better life. Rebuilding a nation after such a profound collapse is a daunting challenge. The Venezuelan economic crisis serves as a stark reminder of the consequences of failed economic policies and squandered resources, leaving a nation to ruin. Which economic collapse's story impacted you the most? Share your thoughts in the comments below, and let us know if you'd like to see a part 2 exploring more economic collapses. Join us next time as we delve deeper into the events that have shaped our economies, because every economic collapse has a story worth telling.